Good morning, everyone.
Welcome, Sunday.
Thank you very much. My President.
Good morning.
Morning, I greet you all.
Morning.
Sorry, I have to stand in for my chairman, Mr. Sam Onokwe, who is unavoidably absent now. So he has asked me to really step in place to make sure that there is no vacuum created. So I don't know whether are we on now so that maybe we can start the program.
Yeah, we'll start. I think the
So I can't hear from here.
Good morning, sir. We're actually live, and I believe we can start now. We'll come to you shortly. Thank you. Please, let's proceed.
Good morning, everyone. Once again, I think we have 122 participants on the call. I believe we are good to go. So I'll hand over to Ugochi to take the reins.
Thank you so much, Afam, for that. Good morning, esteemed guests, and welcome to the NGX Derivatives Webinar. If you can see me and if you can hear me, could you drop in the chat just something, just a word, just to be sure that you can hear me and you can see me. Thank you. Great. My name is Ugochi. I have the X Academy for the Exchange, and I'll be your guide, if you permit me, through today's informative session titled Exchange Traded Derivatives, Understanding the Trading of Single Stock Futures. At the Exchange, we are excited to offer this session, which will explore the world of exchange-traded derivatives, with a particular focus, not just on derivatives alone, a particular focus on single stock futures. As we delve into the intricacies of this dynamic market, what we aim to do is provide you with comprehensive understanding of its mechanisms, opportunities, and guess what? The challenges as well, and provide you with solutions. The theme of our webinar, Understanding the Trading Single Stock Futures, holds a particular significance in today's context. Don't you agree with me? In this era marked with rapid changes and continuous evolving happening, single stock futures represents a crucial frontier in this evolution, offering you new avenues for portfolio diversification and risk management. So through this webinar, with me being your guide, what we're going to do is provide esteemed speakers, experts, which will guide us through the various facets of derivatives trading. Thank you. I can see everybody can say they can hear me loud and clear. Fantastic. So you will hear from industry leaders on topics ranging from market structure, trading strategies, the role of derivatives. You hear from the NG clearing on how the processes occur. But beyond all that, the panel, the panel will be very interesting because you're going to hear real life scenarios. So I encourage active participation from you. Get out your pen, get out your notebooks, identify the Q&A button so that you can drop all your questions. I guarantee you that your questions will be answered live or even spoken about. So please don't hold back, right? So without much further ado, I can see that already people are excited. We're over 200 here. I'd like to welcome the acting CEO of NGX Limited, Mr. Jude Chiamaka, to give his opening remarks. Thank you. Mr. Jude, are you here? Thank you.
Thank you very much, Ugochi. Good morning, distinguished ladies and gentlemen. On behalf of the Board of Directors, Management, and staff of the Nigerian Exchange Limited, I'm truly delighted to extend a heartfelt welcome to all of you for joining us for this year's Derivatives Market Webinar. Today marks a significant milestone in our journey towards fostering a deeper understanding of the intricacies of derivatives trading, particularly as we embark on the forthcoming launch of single stock futures. This webinar stands as a testament to our unwavering commitment to empowering investors with the knowledge and facilitating informed decision-making in capital markets. Derivatives have emerged as indispensable instruments in today's financial landscape, offering unparalleled opportunities for risk management and market participation. As we delve into the nuances of exchange-traded derivatives, we recognize the pivotal role they play in enhancing market liquidity and fostering economic growth. Globally, derivatives have become ingrained in risk management strategies, with over 90% of the world's 500 largest companies across 26 countries utilizing derivatives, according to the International Swaps and Derivatives Association, ISDA. This trend is reflected in the latest World Federation of Exchanges 2023 derivatives report, which highlights continued double-digit growth in exchange-traded derivatives. The report shows 56 billion contracts traded, with 42 billion of option and 14 billion of futures. Notably, single stock futures contributed 2.3 billion to this total, indicating their growing importance with the derivatives landscape. The global derivatives market size is projected to reach $39.17 billion by 2027, from its current $21.98 billion in 2020, at a compounded annual growth rate of 8.6%. The NGX derivatives market holds immense promise as a catalyst for innovation and diversification within the Nigerian financial ecosystem. Our steadfast dedication to upholding international standards and best practices ensures that we provide a robust and transparent trading platform for investors. So today's webinar, themed Understanding the Trading of Single Stock Futures, serves as a beacon of enlightenment, illuminating the pathways to unlocking value in this dynamic asset class. We are privileged to host distinguished speakers and experts who will share their insights and experiences, enriching our collective understanding of derivatives trading. I extend my sincere gratitude to our distinguished partners, NG Clearing Limited, and the Chartered Institute of Stockbrokers, CIS, as well as Association of Securities Dealing Houses of Nigeria, Action, whose unwavering support has made this event possible. Your commitment to advancing investor education and market development is truly commendable. I must also, at this point, extend our profound gratitude to the Securities and Exchange Commission, who have really cleared the pathway for us to be able to trade this particular instrument. To all our esteemed participants, I encourage you to actively engage in today's discussions, leveraging the opportunity to deepen your knowledge and explore the myriad possibilities within the NGX derivatives market. Today, let us seize the opportunities that lie ahead and chart a course towards a more vibrant and resilient financial future. Thank you so much for joining us, and I wish every one of us happy and truly rewarding participation at this event. Thank you, and over to you, Gochi.
Thank you, Jude. Thank you. And as you've heard, if you have somebody sitting close to you that isn't in this, drag the person in to come in and listen, because as I promised, and again, Jude has promised you, it is going to be quite an exciting webinar, not just like any other webinar you've heard about before. So before we start, because we have a lot to give to you today, we can't go on without hearing from the president of the Chartered Institute of Stockbrokers, CIS, Mr. Oluwole Adeosun, for his 2 minutes brief remarks. Thank you. You're muted, sir. You're still muted, yes. Thank you.
Okay, I'm off now. I believe I'm okay now, right?
Yes, sir.
You can hear me? Okay.
I can.
Well, thank you very much, Gochi, for bringing us on board. Distinguished panelists and participants at this webinar on joint derivatives markets. I want to welcome you on behalf of the Chartered Institute of Stockbrokers. And indeed, the CIS is happy to partner with the NGX Exchange Limited, the NG Clearing Limited, and the Association of Securities Dealing Houses of Nigeria, ASHON, to organize this derivatives market webinar captioned "The Exchange Traded Derivatives, Understanding the Trading of Single Stock Futures." The distinguished council member of the Institute and the acting CEO of the Nigerian Exchange Limited, Mr. Jude Chemeka, has already laid the groundwork of what we are here for today, for this brief 2 hours period of engagement. And I just want to extend the support of the Institute towards this webinar initiative, which we serve as equipping us further for this grand event that we're having, introduction of these single stock futures into our market. If I go back down to memory lane, on June 28, 2021, the SEC approved 7 derivative products to be traded on the Nigerian capital market. Subsequently, in April 2022, the NGX Exchange Limited launched the West Africa first exchange traded derivatives ETD market with equities index futures contracts, and listed 2 of the products, the NGX 30 index futures and NGX pension index futures, for trading on the NGX Exchange derivative market. The NGX Exchange is now prepared to list and launch the remaining 5 derivative products: the Access Holdings PLC stock futures, Dangote Cement PLC stock futures, Guaranty Trust Holding Company PLC stock futures, MTN Nigeria Communications PLC stock futures, and Zenith Bank PLC stock futures. These are exciting moments building onto us in our market. The derivative market is up and running already in our capital market. Currently, there are accredited derivatives trading license holders, while other applications are at various stages in the application process. As operators and investors in the Nigerian capital market, we should be conversant with the rules and regulations guiding trading on this asset class. We should familiarize ourselves with relevant, up-to-date knowledge on derivatives and position ourselves to actively participate in this segment of our market to take advantage of the unfolding opportunities. This webinar is aimed at deepening the knowledge of participants in derivatives products and expose them to the various applications of equity index and single stock futures contracts, including trading and arbitrage applications, and a range of investment fund applications, as well as the risk management, settlement, margining, and collateral requirements. The Chartered Institute of Stockbrokers has a statutory mandate to train and certify traders on the Nigerian capital market. The Institute has over the years provided intellectual leadership in the conduct and practice of finance, securities, and investment in Nigeria. The Institute is prepared more than ever before to produce the much needed qualified manpower to traders for this new derivative market. On this note, I wish to let us know that the CIS will support every initiative that is designed to uplift this derivatives market. On this note, I wish you a successful training. Every one of us there, participants and panelists, have a great moment of deliberations. Thank you.
Thank you so much, sir. Thank you for that. I'm sure that everybody here can feel the pulse of what's coming. It has just given you some intro, some information about the derivatives that are coming up. So are you getting ready? Yes, we are ready to move. But just before we go into it fully, I'd like to invite Mr. Seyinde Adenagba, the Vice Chairman, the first Vice Chairman for Action, to give his 2 minutes brief remarks. Mr. Seyinde, are you there, please?
Thank you very much, Ngozi.
Thank you.
Good morning, everyone.
We don't have your video on. Do you want to go on, though?
Acting CEO, the President of. I want to say I welcome all of you. Actually, I'm here on behalf of our chairman, who is unavoidably absent today. I received this call not quite 10 minutes before now, just to stand in for him because he could not make it. However, there shouldn't be any vacuum created. So I bring greetings from Association of Security Dealing Houses of Nigeria, Action. I want to say that our role in the market is that of an intermediary. The buyer, the seller, we link them together and we move on. But we need to actually deepen our market. We need liquidity in the market. But before we can get all these things, it is very, very pivotal that we maintain trust. When our clients, numerous clients have trust in us, if our words are bond and they see us as we say it, definitely there'll be confidence. And when there is confidence, there'll be reason for us to develop products. In which case, this time around, we're talking of single stock futures. It's a derivative, it's a contract where the buyer and the seller must meet their obligations. And in meeting it, it will definitely create a kind of confidence in the market. We know that in the market today, we've been talking of derivative because we need to create another pool, another basket of investment for all our numerous clients and investors so that we can move the market forward and deepen it. And it is in introducing more and more products like what we are discussing today. I know we have competent panelists that will give us insight and navigate every nook and cranny of the investment world to make sure that what we are talking today is not just on paper, it's not just theory, we put it to practice so that brokers can also encourage our investors to embrace that aspect of the market. And I want to believe that our action is poised to make sure that what it takes, we do. What is our bond? We play by the rule of the game and make sure that we encourage numerous clients to develop and prioritize the investment in our hands and ensure that whatever is given to us, we can go home and sleep because it's safe. And the exchange has produced the platform for making this thing very workable. And in doing that, we are very grateful to the acting CEO who is here present with us, because we know that with him, the platform is there. And also with Mr. Farouk Oreagba, who is the MD of NG Clearing, is also there with us. I'm sure it's going to be a wonderful discussion. And people who are hooked on online everywhere, they will see it as a way to make the market move. And the benefit of it is for all of us. And I'm sure we'll be so glad joining this conversation today. So I want to say thank you very much on behalf of Mr. Onekwe, who could not be here today, that everyone on the platform will enjoy it. So I wish you a very useful celebration as we go along today. Thank you very much.
Thank you so much,
Thank
sir.
you, Ngozi.
Thank you.
Thank you.
Thank you. And as promised, see, he said it. He wasn't, just like I mentioned earlier, you're going to have an exciting and productive time with us today. It is a webinar with a difference. It's giving you theoretical and it's also giving you practical things to take back with you. We are going to run through the role of the NG clearing in clearing and settling of exchange traded derivatives, how it's done. I'm going to give you that information. That we're going to go through trading strategies for NGX Single Stock Futures, how to go about it, how to trade. And then we're going to go through the role of derivatives markets in Nigeria via a panelist, which will give you real life information, more of a discussion. So let's start. Let's start from the beginning. And let's start with the introduction of what NGX Single Stock Futures is all about and the market structure. And who best to tell you all about that than the head of the product development for NGX, Chidima Chukwueke Okolo. Chidima, can you hear me? Are you here?
Yes, I am. Thank you very much for that introduction. And I'll just go straight into it. At any point, connection goes or you can't see, please notify me so I can make adjustments. Okay, good morning, everyone, and thank you for joining us today as we delve into the world of equity futures, single stock futures. I'll just be giving you a brief overview of derivatives, our journey so far here at the exchange, and then give an introduction into equity futures contracts specifically, and then just tidy up by letting you know how you as a trading license holder can become a derivatives member, trading member. Given an overview, I'll just start with a brief introduction. I'll just assume that everyone really knows what the basics of derivatives are, but derivatives essentially are contracts that derive their value from the performance of an underlying asset, event, or outcome. The key elements you should look for when you think about derivatives, like I said, it's a contract. So there are rights and obligations associated to that contract. It's a financial instrument, meaning that it can be traded freely. The performance of this particular instrument is based on the future performance. And again, it's linked to an underlying asset. There are various assets that can be used for derivatives, commodities, currencies, bonds, interest rates, stocks, and market indices. And we'll talk a little bit more about this. But right now, as you know, as NGX, we have equity derivatives, and so we're focusing on the indices and the stocks for now, while we roll out other products later. When you talk about derivatives, the type of derivatives, you have exchange-traded derivatives and OTC derivatives. We at the exchange, obviously, will be providing exchange-traded derivatives, but it's important that you have a background of, a well-rounded background of all the derivatives. So the main difference between OTC and exchange-traded are, obviously, exchange-traded derivatives are traded on an exchange and through a central order book with a CCP. The CCP plays a huge role in the trading and functioning of derivatives. And Nuruddin will give a presentation on that later, but they play a key role in exchange-traded derivatives. In recent times, however, in more advanced markets, we've seen the introduction of CCPs for OTC transactions, but a core benefit is that the risk is managed by CCP in the middle. The cash flows are more simpler for exchange-traded derivatives because the contracts are standardized, while it's a bit more complex for OTC and the contracts are more flexible. And because of that, you usually get a long contract size and they tend to be less liquid. It's more like a bilateral contract, the kind of contracts you see when you talk about oil trading swaps and derivatives like that, which actually do occur in our market right now. But exchange-traded derivatives are standardized contracts. You can get smaller size contracts, which allows for more liquidity and more price transparency. So examples of exchange-traded derivatives that you would have would be futures and options. Futures are what we have at NGX, and these are financial contracts that obligate the contract buyer to purchase an asset at a pre-agreed price at a specific date in the future. When you look at futures, it's a contract that obligates the contract buyer to purchase an asset at a pre-agreed price in the future. With options, the only difference between futures and options is that the option gives the buyer of the contract the right, but not the obligation. So you can look at the market when you get to expiration and decide not to go ahead to complete the contract. On the flip side for OTC, forwards exactly the same as futures, but they're more flexible contracts and they can customize their features. And then the fourth specific type of derivative you would have would be swaps. And these are derivative contracts that allow the exchange of cash flow between two parties. So you usually see the exchange of a fixed cash flow for a floating cash flow. And in swaps would usually be like interest rate swaps, FX swaps, where there's a flow of assets. But for us, really, we'll be focused around futures for now. But I just think it's important that you have a background of the whole derivative concept. So what are the benefits of derivatives in general? It creates a great synthetic exposure, meaning that you can gain exposure to an asset or market without having direct investment in the underlying. So obviously, you may not have that underlying because it's difficult due to liquidity or market timing, tax, or other reasons, but it gives a great synthetic exposure, meaning you get the same exposure you get by holding the underlying. It's a risk management tool. It helps you to manage risk and adverse changes in price of the assets of the underlying. Another key benefit is the opportunity for bi-directional profit making, meaning that you can make profit if the market goes up or if the market goes down. So it allows for seamless short selling, which we don't have in our cash market at the moment. So that's an important benefit of derivatives. You get opportunity for bi-directional profit making, and quote unquote, you can actually short sell, meaning you can take short positions and then make profit regardless of the direction. And there's a leverage opportunity there. So it provides leverage and gearing, such as a small movement in the underlying can cause a large difference in the value of the derivative. So Nuru will also talk a little bit more about that from the CCP's end, but essentially you'll be dealing with margins and collateral, meaning that you only need to put a certain percentage of the value of your contract down, and that allows you to gain leverage on the products and the advantages of leveraging from the products. So briefly run through this, what we have done to bring this market to life. Obviously we did a feasibility study, research. We made sure the regulatory engagement with SEC, CBN, PENCOM, NICOM, and all the other agencies. And there was a legal framework that was done around derivatives to make sure that derivatives can actually trade. This obviously involved the changing of the laws and the creating of rules with the SEC and the NGX. A big thing that we have done is technology, making sure our technology is right to support the trading of derivatives. And then product awareness and development. This is continuous, it's ongoing. It's something that we're doing actually right now, engaging the markets, making sure they have the capacity and the ability, knowledge to trade for themselves and their clients. And then the post-trade system, NGX clearing system provided by the CCP. A company, NG Clearing, was set up as the CCP to provide the risk management and clearing services for this particular market. And then obviously we launched the market as a whole in April of 2022. And now we're looking to introduce and list additional contracts, i.e. the single stock futures we're looking to introduce into the market in the imminent future. Like I said, we launched in 2022. We saw some activity, traded value for about 16 million and open interest at the time of 3.6 million. The CCP, I've mentioned, NG Clearing provides the services, risk management services for the market. At the moment, we have 10 trading license holders that have been accredited to trade derivatives for our market. They trade on behalf of themselves and for their clients. You can see a list of them there: Merisem, Cardinal Stone, APT, Stanbic, PAC, Securities, RMB, Codros, FSL, Chapel Hill, Denham, and Apple Assets Limited. For those that are not on this list, the application process is open. I'll talk a little bit more about how you can become an accredited derivatives trading license holder. And on the clearing members, we have Zenith Bank and Access Bank. And it's interesting to note that because of derivatives, for the first time, the banks have now become capital market operators by merely by the role that they provide in terms of clearing. So we have two banks that are clearing members, Zenith Bank and Access Bank, and it's through these clearing members that you are able to settle and your derivative contracts. And again, NGCL will talk a little bit more about that during their session. Well, initiatives were my CEO, my president, my chairman, they've all spoken about the things that we can do to help drive the adoption and of this product in our market: continuous engagement, more accredited trading license holders, the trainings that we're supporting, like we're doing right now, and obviously introducing and listing more derivatives. Like I said, we're about to launch and list single stock futures. And then obviously we'll look at more products later. And these are things that we're working on to help develop and deepen the market. And obviously we would call on you as well to help us in this effort. So NGX futures contracts. Before we go in, I want you to have these at the back of your mind. What is a future contract, right? And we talked about it being an agreement between two parties to exchange a particular underlying, in this case, underlying stock at a particular date at a particular price in the future. In essence, it's a bet to go long if you expect the market to go up, or go short, sell the derivative, you expect the market to fall. There's no cash payment today. So it's not like you buy a contract and you expect it to make full payment today. That's not the way derivatives work. So it's an added advantage. You have the ability to sell first and buy back later, like I mentioned before, in the market. And there's also tighter bid-offer spreads expected in the derivatives market. When you're looking at contract terms, obviously you're looking at the kind of underlying you want to take a derivative contract on, what contract size, look at the terms of when the contract ends, what is the delivery date, or in our terms, maturity date, and how does this settle? I'll talk a little bit more about these points later. And the participants we expect in the market to be hedgers, people that are looking to reduce the exposure of risk on their portfolio or particular on the line, people that want to take advantage of price differentials using futures, and then obviously the speculators, people that have a view of the market. So that the primary participants that we would have in this market, and I hope are here with us in the audience. So specifically around single stock futures, like I mentioned before, your single stock futures are instruments that allow you to take a contract, that will allow you to take a position in an underlying, and you're obligated to meet that contract. So a future price at a future date, that's standardized contracts in the exchange, meaning that everyone will be trading that particular instrument, a standardized contract, and it gives you opportunity to gain exposure to that particular stock without actually owning the underlying asset. All our contracts on NGX are cash settled. You know, when you talk about commodities and other exchanges, you see where the actual commodity is exchanged. Even some markets, the actual security or basket of index is exchanged. But for our market, all our transactions are cash settled. Again, Nuru will speak a bit more about the settlements and how it's done. All our expiration dates follow the calendar of quarterly expirations, 3-month contracts, March, June, September, and December of each year. There's a convention it's a convention that we have chosen to follow. The specific codes to which derivative contract follows, right? So if you see the ticker, for example, you have GTB, which is GTCO, right? That's the underlying ticker. But for derivatives, you would have the security code, the month code, and the year. So the month code we're using for March is H, June is M, September is U, and December is Z. We didn't make this up. This is a convention that we're following, and then to be followed by the last digit of the year is expiring. So for example, if you have an underlying MTN, so you have MTNN that is maturing in September, will be U. September 2024 will be U4. And that's how you identify each contract on your trading engine, on the price sheets, on the tickers. That's the ticker for the contract. Expiration is the third Friday of the expiration month. This is a convention, again, about following as with other markets. So all the contracts will expire on the third Friday of the expiration month, be it March, June, September, or December. And if it's not a normal trading day, it's, for example, a bank holiday or something, it's a preceding day that shall be used. And conversely, the listing of the following contracts. So the way the derivative work is that at any point in time, there'll be two contracts listed. The current, the front month contract and the back month contract. So there will always be two contracts you can trade for each underlying. So if March and June are running right now, and a March, which is about to expire, matures, we will then list the September contract. So you would have June and September running. When June matures, you would now list the December contract. And the reason this is so that you can roll over your obligations. For example, if you're buying derivatives because you want to hedge, you always need to have a contract open so you can roll over your obligation, because you're hedging, you don't know what your tenure is. Obviously, it could be more than 3 months, which the contract. So we always have two contracts, a front month and a back month contract. And the listing is done the Monday preceding the expiration date. So there's a window of about 4 to 5 days where we have 3 contracts running, which allows you for you to manage your portfolio and roll over any contracts or any obligations that you have onto the following month. So key takeaways here are the tickers, the conventions around the tickers, the expiration convention that we're using, and the listing of new contracts. Obviously, we'll introduce more contracts as time goes. So other things to note about the contract, we've talked about the underlying. We have the 5 of them: GTB, Access Bank, Dangote, MTN, and Zenith Bank at the moment. We will be listing additional single stock contracts as the market progresses. All our contracts settle in Naira. We've talked about the 3-month tenor for each contract. The quotes convention. Now, we listed index futures before. This time around, and the quote was done with a ticker of 25. But now each ticker would be as exactly the same as the underlying. So you could have the contract that's priced at 27.21. With index futures, you would have to do it in tick sizes of 0.25. Again, the contract multiplier is 1,000. We'll talk briefly about that later. So for every contract you buy, to get the value of that contract, you multiply it by 1,000. So if you buy one contract of GTB, for example, at 27, to get the value of that contract, you multiply it by 1,000, and that will give you the full value of your contract. That's what the contract multiplier is. Trading platform, like we said, NGX, NASDAQ trading platform, and obviously supported by the CCP at the back end. We've talked about the ticker and the contract expiration month and the contract expiration day, the CCP, NGC clearing, and fire settlement. All our contracts are cash settled on expiration date. And the settlement cycle, we have a daily cash settlement where contract holders will be required to make or receive cash payments based on the value of their settlement. So again, the CCP will also speak a little bit more about that. We spoke about the multiplier. I just wanted to put an example here. GTB, single stock future that trade at 42.37 Naira, has a contract multiplier of 1,000. So that means the notional value of that contract will be 42,370. So it's important to note the trade and the contract multiplier. All our contracts have a contract multiplier of 1,000. That will give you the value of your contract at 42. I talked about the tick size as well. So each tick size is meaning that a derivative contract can trade to 0.01, just like the underlying asset. It was slightly different for index futures, where the tick size was 0.25. So meaning that whatever price it is, it rounds up to the nearest 0.25, and it trades 0.25, 0.5, 0.75, and then the next whole number. But for single stock futures, it trades to 0.01, just like the underlying asset. Apologies, I'm just trying to catch up with time so we can get through to the other presenters as well. Generally, the market players, we have obviously the investors, retail and institutional investors. We have the trading members that would take these orders and do the trades. And then a key part of through the trading engine that we have. And then obviously a key part of this macro structure is the CCP. And they provide the margin and collateral and settlement services. All the trade data goes to the CCP, and the CCP are able to pull reports of your trading activities, of your settlements, of your obligations, and back through the clearing member, the trading members, and then through the client. So this is the ecosystem that we have for derivatives. Includes the clearing members, the CCP, the trading members, and the investors, be it institutional or retail investors. Just important to note that margins are the daily margin calculations that would occur. And again, I'll leave that for Nuri to provide more insight during his presentation. We talked about the people that use derivatives. So these are the particular investor classes that we're looking at using derivatives. So fund managers would use derivatives to protect their long-term investment views and hedge their portfolios. There's cash drag can also be used for cash drag. For example, if you are a mutual fund and people are making contributions to your mutual funds every day, so you can't go to the market and be buying piecemeal of your equity pie or the equity portfolio. So that cash that you have in your account, what you do is to buy a derivative that reflects your portfolio, and that's how you take care of the cash drag on your portfolio. Again, portfolio managers, like I mentioned before, also use it to replicate the market for index futures or just a portfolio that they have and then use it to hedge. And again, the proprietary traders and the investors allows for maximum capital efficiency because you don't have to put out the whole notional. You just put a percentage based on the margin required for your trade, and obviously you're able to take a position long and short on the market. Quickly just go through this very, very quickly. Requirements for trading to become a derivatives trading license holder. There's a lot of text here, but be rest assured, if you are already a trading license holder in the cash market, it's only a very little step for you to become a derivatives trading license holder. Just specifically around the human resource requirements, the capital requirements are the same if you're already a trading license holder, and then your business operations and the technology that you have, and then you can put your application through. But this information is available on our website, and you can reach me directly for this information or more details on this. Again, you go through the application process. NGX Redco will be reviewing your, they have oversight over the broker dealers. They will review your application, do the examinations, and then give you accreditation, and then you have access to the derivatives. Right now, you do not have access to the derivatives board on the trade engine until you're an accredited derivatives trading license holder. So you will not see the derivative contracts on XGen or your trading system until you are accredited derivatives trading license holder. So thank you. That's just a brief introduction into the offering that we have at the NGX. If there are any questions, we'll take it at the end. But please do listen through to the rest of the other two presentations to gain more insights on the product. Thank you for your time. Ngochi, please, over to you.
Thank you, Chidema. If you call that brief, then it tells them that there's a lot more and they should be excited and yearning for more. Thank you very much for that. As Chidema has mentioned, please drop in your questions. I see a hand up, but please drop your questions in the Q&A using the Q&A feature, and we'll get them answered. That's a promise. So Chidema mentioned that the Clearing was launched in 2021. Let's get to know a bit more about their role in clearing and settlement of these exchange-traded derivatives. And so I'd like to call on Nuruddin Omarka, the acting head of operations for NG Clearing Limited, to give us more insights into that. Nuruddin, thank you. And thank you for helping me manage the time.
Thank you. Permit me to share my screen.
Please go ahead.
All right. Morning, everyone. I'll be talking about the role of NGCL in the clearing and settlement of exchange-traded derivative. I understand I have limited time. Let's see how we can manage it. So the outline for today is about NG Clearing, our services, the capital market, the role of NG Clearing as a CCP, the overview of our processes, how trade settlement is being done, how we manage risk and the collateral, and also we'll talk about the default waterfall, which is a tool CCP used to manage default if there is any. So NG Clearing was incorporated 2016, and we got our approval 2021 from SEC to operate as a central counterparty CCP. Therefore, what is a CCP? CCP is a financial market infrastructure that comes in between buyer of transaction by becoming a buyer to every seller and seller to every buyer. That process is what we call novation. So once a trade is executed between counterparty A and counterparty B, counterparty A is not seeing counterparty B, they are seeing NG Clearing in between the transaction. By then, we become a buyer to every seller and seller to every buyer. Then we novate the trade, right? And the role of NG Clearing is to deepen the Nigerian capital market through a robust world-class clearing platform, because our system is robust enough to ensure that all risks are mitigated in the market. These are our core services. We have risk management that ensures that counterparty risk is managed by collecting collateral and margin before a trade is done. The market is pre-funded, unlike cash market that you can trade on Assetto or Tip or Steering. Before trade is done in the derivative market, you must fund your collateral account, otherwise you cannot execute trade. We also have clearing and settlement that ensure that once trade is executed in the market, we establish an obligation between buyer and seller. Therefore, we become a buyer to every seller and seller to every buyer, right? Unlike OTC, that buyer and seller are seeing themselves directly, but with the help of CCP, you are seeing CCP as your buyer or as your seller. Of course, before trade is done, as mentioned earlier, we collect collateral from both the buyer and the seller to manage exposure in the market. And we will not allow any trading member to trade above what they have deposited with the clearing member that's coming to CCP. So these are some of the roles of NG Clearing as a CCP, right? We increase efficiency in the market by mitigating counterparty risk, and that is done by collecting margin from both buyer and seller before trade is executed. By that, we guarantee performance of the trade, meaning that even though counterparty A defaults today, trade must settle. In fact, counterparty B will not be aware of default in the market. That is being managed by CCP. That is the core role of CCP. Unlike OTC, that if account is not funded by one bank, trade will fail. But the help of CCP, trade must settle irrespective of funding issue with counterparty A or B. And that is being managed, we see in due course. By that, we reduce settlement cost because we carry out what we call netting. If you are buying asset-backed future expiry 3 months time, we also sold asset-backed future expiry 3 months time. We will do the net and credit the differential. We are not expected to bring the full payment for the transaction. By that, we allow anonymity of transaction, meaning that counterparty A and counterparty B are not seeing themselves. They are seeing NG Clearing in between all their transactions. Assets back is not aware of Zenith back. Zenith back is not aware of assets back. All they are seeing in the market is NG Clearing, right? By that, we allow liquidity, because there are some guys that don't trade with themselves because of the past default that has happened. But with the help of CCP that allow anonymity, nobody will be aware of the counterparty. By that, liquidity will be enhanced. Then we also establish obligation between buyer and seller. Once a trade is done on the exchange by APT, a cardinal store, for example, CCP will come in between them and establish obligation with them. APT is not see Cardinal Stone is not see APT. They are see NG Clearing as buyer, seller in transaction, and we advise them of what is due to be paid to CCP, as it be assured that the obligation is met. NG Clearing as a CCP also ensures there is transparency, because according to IOSCO principle, a CCP must disclose their risk management framework, settlement price, open position, and the margin that is being collected in the market. So NG Clearing is not an exception. We ensure that that transparency is maintained in the market. By that, the trader or the client cannot make informed decision of the next day trading. So these are the two types of clearing we have. We have bilateral clearing and centralized clearing. Bilateral clearing is the OTC that Chidima mentioned earlier. We have buyer and seller. They directly interact with themselves and to settle transaction, right? While with the help of centralized clearing, an intermediary known as CCP, consider counterparty, now come in between the buyer and seller, right? Now serving as a buyer to every seller and a seller to every buyer. That process is what we call novation. What trade is done? The trade is novated by a CCP. So the two diagrams I have here will enable us to explain this better. Looking at the diagram A, I have 4 bags that are involved: bag A, bag B, bag C, and bag D, right? So bag A is selling 125 units of asset-backed future to bag C, right? Bag C is selling 100 units to bag D, selling 10 units to bag B. Bag D that bought 100 units from bag C is also sold 100 units to bag B. Why bag B sold 50 units to bag A? Look at this diagram now. That is the bilateral clearing that they interact with themselves directly. It is even scattered, right? It is complex in nature. And let us assume bag A is not able to deliver the 125 units of asset-backed future to bag C, meaning that bag C will not be able to deliver to bag D, and bag D will not be able to deliver to bag B, right? A default are setting. That default that are setting that only enable bag C to deliver to bag D. Bag D is not also able to deliver to bag A. That's what we call systemic risk, and this will cause a catastrophic destruction in the market because they are facing themselves directly, right? But with the help of CCP, looking at the second diagram, right? CCP is now coming in between all the counterparties for the transaction, right? Enabling that bag A, bag C, bag B, and bag D have their net position. Bag A is not seeing bag B, bag C is not seeing bag D, bag D is not seeing bag B. All they are seeing is CCP. CCP has collected the 125 units from bag A, right? Perform the calculation and give the net position to bag C, which is 15, right? Also collected 100 units from bag C, 10 units from bag C again, perform the net position and give the net to bag D. Looking at this second diagram now, everything is clear and transparent. So even though there is a default from bag A today, bag C will not be aware of any default. The trade must settle as agreed. That is the help of CCP. So, by looking at this second diagram, all the roles of a CCP I mentioned earlier has been clearly performed. CCP has established obligation between all the parties involved in the transaction. CCP has also provided transparent report to all the parties involved in the transaction. CCP has guaranteed settlement for all the parties involved in the transaction. And CCP has also collected margin from all the parties involved in the transaction, right? You can see that even though we have 100 clients or 100 counterparties here, nobody will be aware of the other. They will only be CCP as a counterparty. That's why it is called central counterparty. So this is how clearing works, right? I have CM1 and CM2. CM means clearing member. Clearing member, they are banks, Nigerian banks that have been approved by SEC and onboarded by NG Clearing to carry out the role of derivative clearing and settlement in the market, right? And we have types of clearing member, GCM, PCM, and clearing member. But let us focus on this for now. So I have clearing member 1 and clearing member 2. CM1 is buying, CM2 is selling, right? CCP has come in between CM1 and CM2. CCP has established obligation between CM1 and CM2. CCP has collected the cash, that is payment obligation, from CM1, pass it to CM2, collect the asset from CM2 and pass it to CM1. Trade is settled. CM1 and CM2, they are not aware of themselves, they are only seeing CCP. And again, before this trade was executed, both CM1 and CM2 must deposit collateral to enable them to execute transaction in the market. Looking at the second diagram now, let us assume that CM2 is not able, is unable to deliver its obligation. CM2 has failed, right? Will the trade still settled? Yes. Will CM1 be aware of any default from CM2? No. CCP will now utilize the magic of CM2 to ensure that the obligation is settled as agreed. Unlike the OTC, that trade will fail. With the help of CCP, trade will not fail. So this is the derivative clearing and ecosystem, clearing and settlement ecosystem we have as of today. All right. We have the client, we have trading member, we have clearing member, we have NGX, which is the trading venue, we have NG clearing, and we have NIPS. So let us start with the client. The client, that the potential investors, right, that have agreed to trade in derivative market. It can be retail, institutional, and what have you, right? We now have trading member, which are accredited by Nigeria Stock Exchange to carry out derivative trade and settlement in the market, right? And this trading member, once accredited by the exchange, must be onboarded by clearing member through the platform provided by NG Clearing, right? As mentioned earlier, clearing member, they are Nigerian banks that have been approved by SEC, onboarded by NG Clearing to perform the role of derivative clearing and settlement in the market, right? So we have the NGS, that is the trading venue, and we have NIPS, which is the entity we use to pass the debit and credit to clearing member account with CBN on a daily basis. So now, client 1 and client 2, they have agreed to execute transaction, because before we have a trade, we must have a buy and a sell side. It's a must, otherwise we don't have a match trade. Now, trading member 1 is buying, trading member 2 is selling, right? While the trade is executed on the form of the exchange, it flows to NG Clearing system on a real-time basis, because we are connected to NG Clearing, we are connected to clearing member, trading member at the exchange on real-time basis. Once trade is done, we see it on the real-time basis. Margin is computed to protect the exposure in the what market. Then clearing member 1 is also seeing clearing member 2. Right? Once the trade has been executed, NG Clearing novates transaction instantly by becoming a buyer to every seller and seller to every buyer. And we monitor the exposure from beginning to COB to ensure that no trading member or clearing member will take exposure above the collateral they have deposited with NG Clearing. That is number 1 risk we mitigate in the market. Good. So by COB, we compute settlement price, we compute the margin that's required, we compute the variation margin, and we use NIPS to pass the debit or credit to the respective clearing member, which are banks. We expect the banks to pass this debit or credit to trading member same day. And we also expect trading member to pass this debit or credit to their client. Very important to note, NG Clearing as a CCP does not have direct relationship with trading member. Our direct client, they are clearing members. However, we provide services to trading member once required, because we have provided system for clearing member to ensure that the trading member are well onboarded. So this is the deposit and collateral we have. We have 2 types of collateral as we speak today. We have membership deposit and we have magic deposit. Membership deposit, they are funds that are contributed by the clearing member, right? In case there is default, and this fund cannot be used to protect any exposure in the market. The minimum deposit as of today for clearing member is 5 million. However, it's not cast in stone. Once the exposure in the market is improving, the volatility is moving, the default fund or membership deposit will also be recalibrated to reflect the current market condition. And that default fund can only be used if there is default. No member can use that default fund contribution to trade in the market. While magic deposit, they are the funds that trading member can use to protect exposure in the market. Before trade is done, clearing member is expected to collect the margin from trading member, pass it to NG clearing. And this margin is normally in percentage, can be 5% of the notional value, 10% of the notional value. It's not cast in stone, it's not fixed. Once the volatility in the market is going up, margin will also be recalibrated to go up to ensure that if there's a default today, the default CCP as collected from the member will be sufficient enough to cater for that default. That is the excess of deposit margin. And when that trade settles, or when the contract expire, or when you squared off, meaning you exit the position, that margin will be returned back to your account. However, the amount of market done on a daily basis is gone, but the margin is yours. Once the contract is settled, it will be returned back to the trade to the members' position respectively. So this is a practical example of margin, right? So let's assume that a member is taking GT code Z4, right? That is GTB future, expiring December this year, and the percentage is 5%, right? And you are buying 10 units of that contract, and the price is 27 naira, right? So to get the notional value of that contract, you multiply the price, which is 27 naira, times the number of the unit you are buying, right? 10 units, times the multiplier factor, which is the amount also mentioned earlier, which is 1,000. That will give you like 270K. 5% of that amount is the margin required for that transaction, which is 30,500 naira only. Or like normal cash market, that you will deposit the full collateral, that you deposit the full settlement amount before trade can be settled. But with the help of the CCP that allow leverage, it's only percentage of that that is needed to settle your transaction. So there's what we call magic call. If you have deposited like 1 million, you have used 900K, or remaining just like 100K, right? You'll be receiving a lot. You have used 900K of your 1 million. You are hereby required to deposit additional margin if you intend to trade more, or you have the option to square off your existing position. Otherwise, the member will be put on RRM mode, meaning that risk reduction mode. You cannot trade more, you can only square off your existing position. And if that is not honored, CCP has the capability to suspend the trading member from taking any further position in the market. And everything is automated. It happens on a real-time basis with the robust system we are provided for the market. So this is the overview of clearing and settlement process, right? I've just been informed now I have less than 5 minutes. Let me see how far we can go. So this is the normal operation on a daily basis, right? As mentioned earlier, once members have been onboarded, they must deposit collateral before they can trade. We expect them to pass this collateral to clearing member pass it to NG clearing. Then we also expect the clearing member, which are banks, as defined earlier, to now go to the system to provide limit, meaning that if Cardinal Stone or APT are provided 5 million to any bank will set limit that CCP allow this guy to trade to the tune of 5 million. They cannot take exposure above 5 million, right? I will monitor that on real-time basis, and CCP will never allow any member to take exposure above what they are deposited in the market. By that, we guarantee market performance. So we also have trade execution, right? So once the margin is in place, the trading member can now approach the exchange to execute the transaction. And when that is done, it flows to CCP on a real-time basis. CCP now novate the transaction by becoming a buyer to every seller and seller to every buyer, right? So we carry out real-time position monitoring from client level, because trading members have their underlying client which have been onboarded on the system. We monitor their exposure down to client level. We perform intraday margin recomputation, meaning that if the price of access back future in the morning was like 27 naira, by 12 p.m. it's now moving to 30 naira, margin will be recalculated. If the mentioned margin earlier was 5%, price has dropped to 30 naira, margin will drop to 6% or 7%, depending on the volatility we have in the market. We also have what we call market-wide position limit monitoring, meaning that if the free float of access bank as the underlying is 1,000, right, we will not allow any derivative contract to trade above 1,000. That is what we call free float. So we monitor it on a real-time basis. Then, 3 minutes left. Okay, so we also have settlement. We also perform clearing and settlement on a daily basis by computing settlement price, because the exchange have their price, CCP also have our price, right? And that settlement price is what is used to derive the mark-to-market value, right? The open position of the contract, and to recalculate the initial margin. Great. And before we have mark to market, there must be two settlement prices, and settlement prices cannot be the same. So look at yesterday's settlement price and today's settlement price. The differential will inform what the mark to market will look like. We now advise NIBs to debit or credit the corresponding clearing member. We expect clearing member to pass that debit or credit to their client or same day, right? That because we have two types of settlement on T plus 0 and settlement upon expiry of the contract. And we provide all these reports to all the participating members in the market. The report can be the margin that you utilize, the transaction fee, the open position report, and co. Very important, our margin is based on HVAR, meaning that historical value at risk approach. We have collected 10 to 15 years data from the exchange, right? We subjected to 3.5 sigma and 3 sigma to determine what the margin will look like. Because of time, let me move to the next slide. So this is the trade settlement process. We have daily settlement at expiry of the contract. As mentioned earlier, CCP will establish the obligation and pass that obligation to all clearing members, which are banks in the market. Obligation can be mark-to-market loss or gain, damages, penalty, fee, and any other level, right? Also mentioned, each day on the T+0 settlement cycle, CCP advise NIBs to either debit or credit the corresponding bank, right? So at NGX Clearing, we have the capability to do both physical settlement and cash settlement. But for now, both index future and single stock future, they are cash settled. But we have the ability to switch to physical settlement if the need arises. So we perform what we call daily mark-to-market position to know the current value of your asset to the market, right? By looking at yesterday's position and today's position are subjected to daily settlement price. And settlement upon expiry, we use the underline as received by the exchange, because upon expiry of the contract, the T is 0. Once T is 0, the settlement price calculated theoretically must be the same with the underlying price as received from the exchange. So this is exposure monetary flow, how the trade is done. Once trade is executed, it flows through us from fees to NGX Clearing system. NGX Clearing system compute margin on real-time basis. The system check APT executing this transaction, is the collateral adequate? If yes, exposure is taken. If no, margin call is made and trade is what rejected. Fast because of time. So this is the collateral utilization monitoring screen. As mentioned earlier, CCP will not allow any member to trade above what you have deposited. The first one I have here is the normal mode, meaning that you deposited 100%, what you have utilized is less than 100, so you can trade. That is collateral is sufficient, no violation. The risk reduction mode, meaning that you have utilized like 80% of your collateral, but it's still less than 100, but you have utilized like 80. The trading member will be receiving automatic alert. You have used XYZ amount of your collateral, you are required to deposit more, or you squared off existing position. That's what we call magic call, right? If that magic call is not honored, CCP will deactivate that member, and everything here happen on real-time basis, and it is fully automated. No manual intervention is involved. This is default fund contribution. As I mentioned earlier, this default fund is a fund set aside that cannot be used to take exposure. It can only be utilized when there is default. CCP contribute to this fund, trading member contribute to this fund, right? And the margin you also contributed is part of the general total settlement guarantee fund, right? We can only use this fund if there is a default in the market. How that fund is being used, we will see it shortly. That will be my last slide. Because of time, I'm a little bit fast. So this is how the fund will be used if there is a default in the market today. Let's assume APT Cardinal Stone. Sorry for using your name. Let's assume that you guys have defaulted, right? the defaulter's initial margin will be used. APT contributed 5 million for margin. APT has defaulted today. That 5 million will be used to cater for that default. Let's assume the 5 million is not enough, right, to cater for that default. The full amount of the clearing member of that guy that defaulted will be used. And I can guarantee you for free, we will never get to this, because for the crisis that happened, right, it was only 35% of the initial margin that was used to cater for the default, not even up to 50%. So our risk management tool ensures that the margin contributed must be sufficient to cater for the default. That is why we subject it to 3 sigma and 3.5 sigma, right? So if the margin is not sufficient, we use the amount contributed by the defaulting member to cater for the default. Let us assume.
Thank you, Mr. Omaka. I know you have a lot to say, but for the audience, we have a 1 hour, 30-minute session just on this. It is going to be soon advertised. Even at the Academy, we have a training on derivatives that will give you more time on this. So my apologies for cutting it, but please drop in all your questions in the Q&A and we will take them. I see some hands up, but indeed, we need you to drop in your questions. Thank you, Nuruddin, for that. It was quite interesting. Please, as I mentioned, drop in your questions. You've heard about the single stock futures, what it's all about. You've heard Nuruddin talk about the role of NGCL in clearing and settlement of these derivatives. What about the trading strategies? How do we go about that? And that's where we have Mr. Philip Umaoge, the principal of PU Consultancy, to please tell us a bit more on that. You have 10 minutes, please. Thank you.
Thank you very much, Ugochi, and good morning, everyone. I hope you're getting some value out of this seminar so far. Just because in the interest of time, I have shared my screen and I'm going to just dive straight into the presentation here, okay? Let's just say a brief outline. I'm just going to go to quick introduction once again on single stock futures. We're going to look at what single stock futures bring to the table. Look at some the potential and advantages in trading this class of instruments. All of this will tie to the formulating the trading strategies. And then we'll look at the likely objectives of the single stock future trading, which has a direct impact on what kind of strategy you will be most likely to undertake. And then we'll look at formulating the strategy itself, and then quick final thoughts. So let me just start. So a brief recap, just quick recap again, just building off what Chidima had mentioned, is that for single stock futures, these are going to be equity or equity futures. These are standardized contracts based on blue chip, fairly liquid premium equities that are going to be traded on rolling 3-month contracts, right? The fact that they are standardized means that it's easier to understand both the timing in terms of the delivery dates, and because of that, it's kind of easier to determine pricing or expected pricing. These are going to be cash delivered, so that also has a little bit of an impact, especially in portfolio construction and the like. So there's no actual delivery of the securities. And this kind of affects how we use them as a hedge, because if they were going to be asset delivered, then you could potentially use them not just to lock in pricing for purchase, but to actually buy or trade the security in advance. But they're cash delivered, which also has some benefits we'll get into. As Nuruddin touched on at length, we have their margin, and as Chidima said, they are margin-based trading with Novation. So we know Novation is the CCP, and the risk management is provided by the CCP. The margin trading with leveraging, which allows leveraging, has a significant impact on this. Now, one thing to touch on, and I'll go to a little bit more detail here, is that in technical terms, we use similar trading methods. So you can just, buying and selling a derivative or a single stock future is pretty much like buying and selling cash instruments or anything. We have a central order book in which you put your bids and orders, and when there's and then there's a match. The primary difference with this is we have some certified OMSs, order management systems or technical systems that have been certified to support this particular class of trading because of the additional risk management that is required to support trading this class of investment. So currently we have three ISVs that have been certified, with a couple of more potentially coming down the line. And so the exchange requires that trading be done through these OMSs because it's very important, given the inherent risk of the systems, to then have the OMS pool manage things like the margin risk, participation risk, and so on and so forth, which I won't go into this. Another critical aspect, of course, is the fact that there's daily sentiment or mark-to-market, as Nodin said, which guarantees immediate returns. So I'm just going to quickly go to what, this question: what do single stock futures actually bring to the table, right? So first of all, let's say that we're about to launch single stock futures, but we already had index future derivatives, right? And these seem, unfortunately, to have been have the market not fully understand them, but single stock futures, of course, are inherently simpler to understand, right? We know that the value of the future is taken from the underlying stock. And so once you have an understanding of the underlying stock and the potential direction or trading opportunities in it, then the future is simply a way to take a view as to where that stock is going to be headed at that fixed point in time that the standardized contract provides. We think that this then has the potential to attract a new breed of investor, right? And I'm going to touch on this a little bit because I think this is important for a number of reasons. One, like I said, there's daily settlement, which means that on a daily basis, there is actual cash returns, right? Once I take a view of a security, say I decide I want to buy GTCO Z4, which is a contract in Guaranteed Trust Bank that's going to be expiring on December 2024. Then between now when I enter the contract and some point in future, and that December 2024 expiration date, there will actually be mark-to-market settlement going on, right, which allows things. This means that many investors who potentially cannot enter the cash markets for security, because typically your reward in entering the cash market can only be realized when you either sell the security, which of course you have to wait for price appreciation if you want to take that route, or holding on to earning season and dividends. That has a much longer window in terms of expected gains or ROI, which single stock futures and other derivatives, there's a much more aggressive window in terms of the returns, and that potentially means that more speculative style investing can be done. And this, when you add it to the fact that there's an inherent potential to short the market, which we will talk about, can be useful to attract that sort of class of investor that currently does things like, crypto investing or FX investing or even betting on football matches and the like. So there's that. And then ultimately, it's a simpler way to take a view on the market direction. As we just mentioned, if I want to buy and hold an underlying cash security, I have to either have to sell, I have to have the position already bought to sell. If I want to buy, I have to have sufficient funds to cover the entire position I want to take. And then even after I do that, I have to hold for an extended period of time for that security to either rise in value or to pay a dividend. Whereas with single stock futures, I simply have to say, effectively bet on what the price will be at the expiration date, right? We should always remember that futures are linked to the underlying spot price. So when I say, if in my hypothetical contract, if GTB was trading at 29 today, but I think that come December 2024 is going to be at least 25 naira, then I simply just go long on it and buy and take a view that it's going to be 25 naira that day. And as the spot price increases, assuming it does, then I make money, right? And then the person who bought on was on the sell side of that contract. As the spot price increases from that, based on that price that we agreed, the price, all the while that the price is in 25, they are in the money. Once the price goes above 25, that reverses. So the buy side makes money as the spot price increases, the short side makes money as the spot price decreases. So that's, and that daily settlement adds an interesting dynamic to that. But ultimately, we must always remember that this is taking a view on pricing in the market. And that adds another potential thing that it brings to the market. And we'll touch on that shortly. So what are the advantages? What are the into this sort of instrument? One, and of course, the major one is that because it uses margins, we can use leverage to increase market exposure. As Nolden's example showed, in the class of investment that he was purchased at 27 naira, with a multiplier of 1,000, and you're buying 10 units, that would ordinarily be a 270,000 naira outlay. But at the 5% margin, it becomes 13,500 naira, right? Potentially allowing a retail investor to build significantly more exposure. Obviously, they have to maintain margins to be able to cover those positions. And the problem, of course, with leverage of margin is it increases, it magnifies your bet. So increases the potential for upside, but it also potentially increases the downside exposure as well, right? So the additional risk management needs to typically go into this sorts of investments to make sure that one understands. Now, it's positionless. And what do I mean by that? We just said if I wanted to sell on the cash side, on the cash market, I would have to have the position. I would have to have the security that I'm trying to sell. There is no naked short selling. To the extent that short selling exists on the cash market, there's no naked short selling. So I either have to have the position, or I'd have to be able to borrow the position. But in single stock futures or other futures derivatives, you don't have to. I can simply sell. I can simply go short on the future, on the single stock future, or go long as it is. So that means there's less barriers to participation and potentially then an increase in activity in the market. We've already talked about daily settlements, which brings immediate returns and losses. It has much reduced fees compared to cash markets. I think currently the fees at the exchange side is about 0.0005%. In the Q&A, we can go to the details to know. And so that means that, once again, there's the time for my ROI, and there's a potential for increased participation, and there's a less threshold for ROI. Of course, in the cash market, even if I buy a position and I wait for that, and that position appreciates in terms of price appreciation until it covers the fees that's the implicit market cost, which I will have to pay in buying and selling the security. I'm actually not in the money. These reduced fees means that potentially with single stock futures, there's less of that implicit cost to the trade, and then we can move forward. And then once again, because of the fact that it's positionless and all of some things, we know that we have much greater ability to respond to market opportunities and conditions through hedging, the easier shorting, and the like that we've already mentioned. So let me go on to the next slide. And that's before we dive into the actual trading strategies, we need to think of what the objectives we'll be trying to achieve when we trade these securities. So we have, potentially, we have speculative trading where the investor is just taking a view, right? And like we said, single stock futures allows this to be done a lot easier. And I will touch briefly on how it actually helps us. That helps us address one of the maybe fundamental issues in this market, where you can have one-sided markets, where everybody, you want to buy, but security is not available for you to actually buy, right? Because everybody has a positive view of the market and so on and so forth. But with single stock future, you are not just taking a view around the direction, you can also take a view around the potential spot price at the given date. So I'll give an example of how that that can be a boon when we talk about the kind of trading opportunities that we have here. Secondly, we have the use of single stock futures for risk mitigation and hedging, which is probably more of reference for assets, for the type of clients, that's asset managers, fund managers, that's those kind of investor classes where typically you may have to hold positions either on the long side. Well, it has to be on the long side because of inability of short selling. That could be statutory or necessary for portfolio balancing. And then single stock futures gives you an ability to then mitigate or hedge against some of those positions. And similarly, it can be used to do portfolio balancing, although that's a little bit limited because they are cash settled, not actual asset delivery. And then for improving cash utilization and equitization, which I think Chidima touched on a little bit in her example. Yeah. So we're going to go.
Philip, can we have your final words? My sincere apologies. In 1 minute, that would be most helpful.
Right, thank you. Okay, all right. So, okay, so I'll quickly run through just some of these things. For formulating strategies, we've said already that just to create a trading strategy, you really need to understand fundamental analysis and do your risk management on the actual underlying class, which is the equities that the futures are based on, because you are still fundamentally trading the spot price, the price in some kind of feature. So you need to understand which sense where it's going and understand the market trends. You have to understand the impact of the earnings season. So how are the potential dividends or bonuses going to drive that underlying system? It's important to note that because bonuses alter price, the single stock futures are automatically adjusted in pricing when those bonuses happen. That's technically done, so it's not something one needs to sort of worry about. And then you still need to maintain things like portfolio diversification. So I'm just going to, we won't have time to go through the rest of this. So like I said, there's going to be potentially a future training to look in some of these things, but you can take a position based on that. It allows you to do implied shorting of this on underlying equities. In terms of hedging, we can do all kinds of hedging, long, short, cross, perfect hedging. We can use it to offset a position that we have to hold on the portfolio, because we can sell a single stock future that then allows us, while holding the underlying instrument, to sell the futures to then balance maybe potentially risk. If we see there's a risk of price going down, but we have to hold the security maybe for dividend, maybe for other reasons, we can sell a single stock future to hedge against that. And the other sort of risk mitigation efforts within that. We can use that for portfolio balancing. And because it's the hedging, we can use the fact that we use smaller amounts to maintain the position to build more efficient portfolios by taking advantage of that leverage to gain the same potential exposure while building diversification and risk mitigation, and to lock in prices for future things. So these are some of the trading strategies that will drive what investors want to achieve. And we will use that. And these are things that as we start practicing these investments, we will see. So final thoughts, the technical trading remains the same. You have to understand the market. The surveillance, NGX surveillance department, so I'm going to say this because it's important, will play a key role, because once you're trading derivatives, you need to address potential market manipulation of the spot price. So the NGX department has been working on this as well, to make sure that there's efficiency and things in the market. And then obviously liquid markets are better, and that's why we have the 5 rollout equities that we've done. Thank you very much.
Thank you so much, Philip. Quite interesting. There's some questions already, and we will take that at the end. So please drop in all your questions. Having said that, we promised you a very interesting and informative session, and that is what is happening. So we'll dive straight into the panel discussion on the role of derivatives markets in Nigeria. And this will be moderated by no other person than Chidinma Chukwueke Okolo, who is the head product development for the NGX. Chidinma.
All right, thank you very much, Ugochi, for that. And thanks to everyone that has presented before. Clearly, we don't have enough time to fully cover
10 minutes.
all of derivatives in 1.5 hours. But like Ugochi has mentioned, we will have subsequent sessions to focus on each of the topics. So without further ado, I'd just like to introduce my panelists for this session on the role of derivatives in the market. We have with us today Mr. Charles Ebunowu, the Managing Director of Forthright Securities and Investments Limited. I have with us Mrs. Elile Olutimayin, Executive Director of Cardinal Stone Partners Limited. I have Mr. Charles Okonkwo, the Managing Director of Pax Securities Limited. And I have with me Mr. Farouk Ureaba, the Managing Director and Chief Executive Officer of NG Clearing Limited. I had planned to go through the exhaustive profiles, but for time, I can't, and I can assure you very exhaustive profiles. And I also have with us Mr. Kazim Alimi, the Head of Secondary Markets at NGX. So you can look them up and see their profiles, but they have a wealth of experience in the markets and on derivatives. So we'll start with Kazim Alimi. Just very briefly, can you just elaborate on the pivotal roles played by derivatives within the broader scope of the capital markets? You know, how would the introduction of single stock futures affect the overall market landscape?
Okay, all right. Thank you very much. I think you cannot overstate the importance of derivative in the market. Largely, our market is a long-only market, and derivatives coming in gives us the option of the market participant being able to have the other side of the market, which would then be to be long and short markets. So right now, without derivatives, you could only just go long in the market. Without buying a position, you can't really make any money or even benefit from the market significantly. However, with derivatives, it gives you that option, being able to then take the other side and then be able to express your views by your actions. And this is also quite present in advanced markets, and also to aids liquidity, drives market participation essentially, and then at the same time also to create a lot more wealth because you don't have assets just being docile as it were. So I think it's going to be quite significant, and I think for short I would just say it's something that is welcomed and would definitely revolutionize the market significantly. Thank you.
Okay, thank you for that answer. I think you've given some key benefits there around the introduction of derivatives to the market, including the short selling and the utilization of cash that the product will provide. So I'd like to ask Ms. Elile, following on the back of this, hedging and risk management are really integral aspects of trading derivatives. How can investors and the Nigerian capital market effectively utilize derivatives to mitigate this risk exposure?
Okay, thank you very much, Chidinma. Thank you, everyone. Thank you for having me. Chidinma, you mentioned it during your presentation, and Philip also discussed it extensively. But I guess I'll just probably give an example to just drive on the points, because a lot of people have talked about hedging and risk management capabilities. In the last 6 to 12 months, if you look at our markets, we've experienced quite a reasonable level of volatility, right? With all the market reforms that we have seen by the new administration. We've had at Cardinal Stone, we've had a number of customers reach out to us to say, you know, they want to be able to express their views in terms of shorting the market. But because we do not have a vibrant securities lending market, we think that derivatives could have come in handy here. So just the way Kazim had mentioned here, people just have only one side of the market, which is to go long, right? Just recently in January, a lot of customers wanted to short the market because they felt that, okay, prices were going, some select stocks, prices were going to drop, and they wanted to be able to express that. So this is what derivatives will do. And I think when Philip was talking, he also mentioned, You might have constraints even as a portfolio manager with regards to not being able to exit your long position, right? Maybe due to float issues, liquidity issues in the markets, you're not able to sell, right? Derivatives gives you that opportunity to be able to express your views and sell, right? Thereby creating an offsetting position. So instead of you experiencing that shock or adverse shock you would have experienced if you did not take an offsetting position, right? What will happen now? Because you have created the other side, gone short via derivatives, you would have reduced the potential loss that your portfolio would have suffered. So I think that it's a tool that portfolio managers can use to build some level of resilience in their portfolio.
Thank you for that, Ellie. That very practical examples, and I think we can all learn from that and take from it. Just to mention that one of the companies under your portfolio, Cardinal Stone Securities, is an accredited derivatives license holder. So you can contact them directly for how to actually actively play in this role. Thank you for that. I'd like to move my next question to Mr. Charles Okonkwo. What specific advantages do investors stand to gain by actively participating in derivatives markets facilitated by NGX? And how would you specifically compare this product to alternative investment options that we have?
Okay. Thank you, Chidinma. I say you have made my job a lot easier because you enumerated a lot of them. Elile and Kazim also did justice to that. But for because of time, I would like to emphasize on the leverage aspect of derivatives generally, and with specific to single stock futures. When NG Clearing was making their presentation, the presenter, Nuruddin, gave an example of somebody taking a position worth 270,000, but you only need to put down 13,500 as initial margin to assume such position. The same is applicable to someone, an investor who wants to take position up to 1 billion. You only need a small fraction of that amount to be able to take that position. But I must also let investors know that you need to do thorough research and ensure that your decision in terms of directional bet is good, because in as much as it takes little amount of money to take that humongous position, the return, be it positive or negative, is on the total sum that position that we have assumed. So you need to do your work. But if I should go to buy the underlying, I will need to cough out all that amount of money. Then derivatives, be it index futures or single stock futures, also helps in cash equitization. Some might call it cash securitization or cash overlay. So you can actually pre-invest money that you are expecting in the future. Once you have enough to put out there for the initial margin, take PFA for instance, you have idea of how much you expect from individual contributors, you know the sum. I need to take a position. You can actually take that position way before the money actually hits you, the cash hits you. And that also helps you to reduce the effect of cash drag. So derivatives gives us a lot of opportunity to take leverage positions in order to magnify our returns. Thank you.
Thank you very much for that. Thank you for elaborating on the benefits around leverage, taking a leverage position, putting down a little bit of cash for a much larger exposure, as well as effectively utilizing, excess cash in your portfolios. I'd like to take my next question to Mr. Farouk Oreba, the MD of NGCL. And NGCL Limited will oversee the critical task of facilitating and clearing settlement of single stock futures. Can you please elaborate on how NGCL ensures transparency, efficiency in clearing and settlement transactions within the derivatives market? Because people always talk about, oh, it's a risky instrument, etc. How would you how would NGCL ensure the transparency and efficiency in clearing of these derivatives?
Thank you, Chidima. First and foremost, it is a risky instrument. There's no doubt about that. And as Charles just said, it's always very important that before you get involved in this product, that you do your numbers, you do your research to make sure you're doing the right thing. Because with futures, you can actually lose more. Just as there's leverage on the upside, there's leverage on the downside. Now, in terms of transparency, what do we have? We, on a daily basis at NG Clearing, even before the market opens, we see all margin positions of the clearing members on our system. So we know if monies have gone in, we see the margin report. As Nuruddin mentioned, if there was a particular house that was approaching their limits, our operations department led by Nuruddin would do the needful to make sure that the clearing member is aware of this. Now, in terms of transparency, the trades executed on the NGX platform, straight through processing, we are notified at NG Clearing as to the trades that have been executed. At that point, as has been pointed out severally, the process of novation takes place. By this, we mean that NG Clearing interposes itself in between both the buyer and the seller. So we become the buyer to every seller and the seller to every buyer. Now, in a real world, these guys, the two participants don't even see themselves. NG Clearing is taking on the risk of both counterparties and thereby effectively guarantees that the trades take place. So in terms of transparency, like you asked, the fact that the trades are not done in our system sort of makes it a little more independent. Those that are trading on the NGX platform, if you're a registered trading license holder, you can see where the trades are executed, just like any other product. In terms of calculating the value of futures contracts, everybody can build a model. We're building a model at NG Clearing. But you can read your textbooks. The fair value of futures contracts are very easy to calculate. And as was pointed out at expiry, the value of the futures contract matches the value of the underlying contract as calculated by NGX. NGX surveillance department is watching potential manipulation. So what I'm trying to point out is each party to a transaction has a role to play independent of the other to ensure that there's transparency, there's no manipulation, and risk limits are not exceeded. I hope.
Thank you. Yes, that's very, very helpful for summarizing that. I think it might give some assurances, but like you said, derivatives are a risky instrument, but I think it's just important if you are aware of that risk, it helps you to manage. And obviously, the CCP will support to ensuring transparency in the market to help you manage that risk. So my next question is for Mr. Charles Ebuno. Derivatives, and this is really from your role that you play in the markets as a key player with CIS, derivatives offer opportunities for a wide range of investors. What strategies and educational initiatives are necessary in Nigeria to foster a greater awareness and utilization of the products or the derivative products, especially around the retail and institutional investors? So Charles?
Thank you. Yeah, thank you, Chidima, and good day to everyone. I think a lot has been said, really, in terms of the derivative as a product, by every one of us here. But primarily, just to summarize, I think most of the communication just relates to basically what we're also doing here in terms of investors' education on the products futures, both the risks and majorly the benefits of derivative as a product. And that being said, derivative itself, if we look at it, serves two major purposes. It's either you want to take a risk or you want to mitigate a risk. by investing in derivative as a product. And if we look at what has happened in our economy, just as my colleague said a while ago, a whole lot of changes is happening in the economic space. And those changes are basically influenced more by external factors. Only this week, we got the report of the outcome of the MPC meeting, driving monetary policy rates by additional 400 basis points. That has, in its effects, affected the activities in the equity market, as we've witnessed. So if we have products, within the derivative space, as it were, just as we have the single stock futures, as it were now, people can short sell. You can imagine the impact and benefits, investors would have had. So I think the critical thing at this stage, really, to drive interest in this product is to enumerate a whole lot of benefits, as it were, to derivative as a product. So take, for instance, with the interest rates going up, as it were, organizations who are exposed to lots of debts, if they have the opportunity, they could enter into a swap, interest rate swap contract, and hedge against, higher interest rates. Things like that could occur, to reduce their financing cost, as it were, And if you also look at what has happened recently in the exchange rate markets, where Naira was exchanging to the US dollars as high as 2,000 Naira. Now it's not coming down, with derivative as well, it could serve as a very good edge for most organizations as well, to mitigate this kind of risks. And it will also allow them to plan effectively in terms of their production cost, forecast easily, by things like, exchange rate forward, as it were. So we also have the very good benefit of the liquidity derivative we bring into the market. So take, for instance, the spot market and the derivative market are like two different markets, as they were. As tradings occur in both markets, it brings about price equilibrium. And when we have a price equilibrium in both markets, there's an equilibrium in the markets. What that intends to do is to ensure that securities are efficiently priced. When securities are efficiently priced in the spot market as well, this is also good for especially organizations who are listed in the main board of the stock exchange, as it were, So they will be able to come and issue their securities as a price they think is a fair value, to them, So I think for communication-wise, a lot of these benefits should be out there for the investors, both institutional and retail investors. Take, for example, as well, asset managers. Asset managers, another very good benefits to them, as has been said earlier on, is the issue of transaction cost, of partaking in that derivative space, with just little amount of money because of the margin requirements. You don't really need to put all your funds to take a long position. You just need to put in some margin. I learned between 5% thereabouts, So I think all these are key determinants and key driving forces that needs to be communicated at this stage, as we continue to educate everyone on how this derivative market is going to work and improve, and help us all in the capital market development. Thank you, Chidima.
Thank you so much for that extensive answer to the question. I think we've taken a lot of points from that. I have a few that have been jotted down. Unfortunately, we're actually a little bit short of time. I really hope to go around and ask a couple more questions that we have. Again, like I said, we would have more sessions so we can elaborate on these a bit more. But just in closing this, I'd just like to call back Mr. Farouk, or whatever, just quickly, just giving your experience that you have internationally, other markets, what advice would you have for our market to help develop our market, ensure that there's sufficient liquidity, attract institutional participation and foreign investors as well? Just briefly, 1 minute, please. Mr. Farouk?
Thank you very much. Quickly, as we're seeing with the index derivatives at the moment, liquidity is the key. For example, we've had houses trying to short this market all week. based on what the results of the MPC meeting, there are no buyers at the moment. So we need to attract other people to the market. Obviously, we need a bit more training, which is what we're looking to do. As you mentioned earlier, we're getting more trading license holders on board, so that's taking care of itself. In order to attract institutional investors, two things we need to do. Number one, we need to be able to accept other collateral apart from cash. So, but those are in the pipeline. And very importantly, we at NG Clearing are now engaging with the custodians. We want a situation whereby you can actually trade derivatives using custody accounts, because that will allow international investors who want to come in to use their custody accounts as opposed to not just putting up cash. But other than that, we're in the right space, we're on the right trajectory. We just need to onboard more people and create a little bit more liquidity. We're not doing anything here that hasn't done before, so we'll be okay.
Great, thank you very, very much. And I want to thank all my panelists for making time out to join and contributing to this very, very important and interesting discourse. Thank you all. Ugochi, please, over to you. Thank you.
Thank you very much, Chidinma, and thank you so much, panel members. That was wonderful, short but really wonderful, and just as has been spoken several times, please watch the space. There'll be more webinars such as this that are coming up, and so that you'll attend at the X Academy. We have trainings that can be done for you or your team, and there'll be open trainings that you can attend and get more information that would help out, that will help you in achieving this. That said, really, really thank you for being here. Now, we can't close this meeting without hearing from the divisional head for capital markets, Mr. Tony Obiezakor, for him to give us his closing remarks.
Okay, good afternoon, everyone, and thanks to Ugochi for that. I believe that in the last 2 hours, this webinar has been very impactful. We've learned a lot, and as everybody has said, this is will be one of the series of events or capacity building initiatives that we would put together to educate the capital market ecosystem and market operators on derivatives. One thing that has been said here that is very sacrosanct is the essence of this product is for us to be able to have increased liquidity in the market, and also to have a risk-adjusted returns for those that decide to play in the market. I also know that a lot has been said today, a lot of technical terms and jargons have been said today, but don't worry, we would, I'm sure, Chidinma, we will share the decks for the presentation, and you would see more engagements to further enlighten both operators and investors. My job is much easier. On behalf of the board and executive management of NGX, we want to thank all our strategic partners, CIS, Ashon, the panelists, of course, the audience. I noticed this is getting to 2 hours since we started, and we still have over 290 people actively engaged and keyed in into this webinar. Remain blessed, enjoy the rest of your week, and I'm sure we would be delighted to have you again. Thank you, Coach. And thank you, everyone.
Thank you, Tony. And thank you, everybody. It was lovely hosting you. We've answered all the questions. We'll send you all the materials, and we look forward to hosting you again in all our webinars and trainings. Thank you. Have a lovely day and a lovely weekend. Thank you to all our panelists.